Well, hello, welcome to Money with Mark Albert. Really happy you're with me today. Guess what? Bank of Canada, another rate announcement today being October the 30th, 2019. Of course, the U.S. Federal Reserve also made an announcement today. Their announcement was that they decreased the rate another 0.25%. It's the third time they do that this year. In Canada, very different decision, and I'll explain why. We'll also consider globally their thinking on the global environment right now, as well as domestically in Canada. And also, before we're done, I'd like to talk very, very briefly about Canada's household debt to GDP ratio and how we stack up against the rest of the G7 nations, and my thoughts on that. So let's get into this together. First of all, just so you know, I do the update every time the Bank of Canada they do a rate announcement. So if this is something you would like, please subscribe below. Also, feel free to like the video and comment and ask questions. Next, the rate announcement this year is my birthday, December 4th. So that'll be fantastic. Looking forward to having you all with me on that one. And then next year they have 8 rate announcements. So they do 8 a year. Okay. So the rate announcement was they decided to maintain the rate. Maintain it at 1.75%. In fact, they've maintained it all year. Whereas in the U.S., the central bank there, they decreased it for the third time this year. All right? So we're going to talk about first globally, their thought on the matter, but then domestically, and so on. And then we have some looking forward, what they're thinking. So globally, the outlook for the global economy has weakened. That's their sense. That's the reality around the world. And weakened further since the bank's July outlook, what they were thinking back then versus now. So ongoing trade conflict and uncertainty are restraining in 3 specific areas. In the area of business investment, trade, and global growth. They're being impacted. You know, these massive tariffs that are between China and the U.S. right now. I saw a chart recently that showed where the U.S. tariffs have grown to compared to in past years, and they've really taken off. So that's going to continue to hurt the economy. So that's something to be mindful of. Now in Canada, you know, all the things I just mentioned about globally, well, Canada has not been immune to these developments. All right, so we're not an island, right? We're part of the overall Canadian, the global economy, right? So commodity prices, as a result, they've fallen in Canada amidst concerns about global demand. So growth in Canada is expected to slow in the second half of this year to a rate below potential. So when the Bank of Canada talks about the economy running at potential, they're talking at 2%. So if we're at 2%, that's running at potential. So this reflects the uncertainty associated with trade conflict, continuing adjustments in the energy sector, and the unwinding of the temporary factors that boosted growth in the second quarter. So what happened back then in the second quarter is there was a lot of temporary measures that really saw like a burst of growth within the economy. So a lot of those temporary measures are kind of dwindling off now, and then that's what that means right there. So also still in Canada, this is one area: business investment in Canada and exports. Those are really a concern right now, and they're likely to contract further before expanding again in 2020, 2021. So they're thinking this second part of the year, which we're in the middle of it right now, they're seeing a contraction of it. It's slowing down, but then they feel that we're going to be running the economy at potential at 2% in 2020, 2021, and of course those that's still to be seen. But that they've been saying that they felt that way pretty much most of this year at Bank of Canada rate announcements. They keep talking about 2020, 21. They felt pretty good that the economy running at potential. All right. So government spending and lower borrowing rates are supporting domestic demand. So the government, in the last 4 years, they've been overspending. They've been spending billions more than the money they got bringing in. So the federal government, they've been going into debt every year. As a result of that, it stimulates the economy and the lower borrowing costs. So we saw the bond yield in the market continue to go down, which impacts the 5-year fixed rate in mortgages. So that's dropped at least 1% in the last year or so. So more people are able to get into the market, maybe purchase a home or refinance their mortgage because rates are a little bit lower. And the activity in the service sector remains robust. So there's some positives, there's some negatives in the Canadian economy. Employment is showing continuous strength, so it's a positive. And wage growth is picking up, another positive, although with some variation among regions. So, they don't break it down per region, but overall, those areas, they seem very positive. They view that positively within the Canadian economy. Consumer spending, now the last rate announcement, I talked about, the Bank of Canada felt that the consumer spending had really slowed down a fair bit. So now they're saying consumer spending has been choppy, but will be supported by solid income growth. So there's a more positive perspective on consumer spending compared to what they thought the last rate announcement just less than 2 months ago. So it seems like it's like a negative consumer spending, but there's a positive to balance that out with solid income growth. So housing activity is picking up in most markets, so that's a positive. And the Bank of Canada continues to monitor the evolution of financial vulnerabilities in light of lower mortgage rates and past changes to housing market policies. So let me pick up on this lower mortgage rate. So when rates drop, there seems to be more of a tendency for people to add more debt load, right? So they can handle that. And so it gives us a bit of a concern, gives me a concern on the amount of debt that the average consumer or household is carrying. So we're going to talk a little bit, I got a chart in just a moment here to show us. But overall, the Bank of Canada expects inflation to track close to 2% target, so that'd be on target, over the projected horizon, 2020, 2021. Concerning the Governing Council, that's a group that makes decisions on these things, is mindful that the resilience of Canada's economy will be increasingly tested as trade conflicts and uncertainties persist. So trade conflicts and the uncertainties in the global economy is not going away, all right? So it's going to kind of test our economy. They feel, and what was mentioned today, and I listened to the announcement on this, they said it's kind of like a healthy person. They may get sick sometimes, but their recovery is be really quick because they're healthy. And so they view the Canadian economy with a level of health. So they're just testing it out to see how it's going to do in response to that. So this is the chart I wanted to get to. So household debt to GDP ratio. So right here we have the G7 plus this one right here. This is the G20. So it's just an average of all the G20 nations. So the debt, household debt to GDP. So GDP in Canada is about 2.2 trillion in Canada annually. And the household debt to GDP is at about 100%. So that means the household debt would be about 2.2 trillion. And compared to everyone else, we're at the worst ratio that there could be. So that's a concern of mine because rates are low right now. And people are a lot more exposed. So if we move into recessionary territory, and a person loses their job, they have all that debt. So these are some concerns. We look at the UK, they're at 86%. The US at 76%. So some of these companies have a lot more debt than we have, but the household debt They have a lot more country debt at the government level. But if you compare household debt to our GDP, we're not faring too strong there. So looking forward, what's the Bank of Canada? If they look forward, what are they looking for? So I put down 3 things here. The Bank of Canada will be monitoring the extent to which the global slowdown spreads beyond manufacturing and investment. So manufacturing and investment in Canada, it's been impacted, but beyond that, they're concerned as to what the impact is going to be. So also, Bank of Canada will pay close attention to the sources of resilience in the Canadian economy, notably consumer spending and housing activity. Those are 2 big components to GDP in Canada. So consumer spending, consumer confidence. So the confidence of consumers within Canada. Oh yeah, I've got a stable job, I have access to money, I'm going to spend. So if consumers are spending and they have confidence, that's a positive. And the housing market. So in terms of new builds, in terms of houses sold, houses bought, these things drive the economy. So they're going to keep an eye on that as well. In terms of the resilience of it within the Canadian economy in light of all the global pressure that we're experiencing. So Bank of Canada will also, they'll pay close attention to fiscal policy developments at the federal level. So the federal government, now that the elections are behind us. So just keep an eye on that, all right? So again, please subscribe. Please note December 4th is my birthday, but also Bank of Canada, they've said, hey, it's Mark's birthday. We're going to have a Bank of Canada rate announcement on that day. Real special day. So you want to be with me on that day. So please subscribe if there's something that's of value to you. And it's great to have you with me. Have yourself a wonderful day, and I look forward to being with you another time soon. Take care.